Welcome to this explainer. Today, we're diving into everything you actually need to know about navigating foreign income tax as a freelancer, digital nomad, or remote worker. It is an amazing, borderless world out there for talent right now. But unfortunately, tax laws, they definitely haven't caught up to that borderless ideal.
So, let's jump right into the big, anxiety-inducing question that hits literally every international freelancer the second they land that first overseas client. You do the work, you send the invoice abroad, but who exactly gets to tax that cash?
Well, the short, unavoidable answer is a resounding yes. Your home country almost certainly wants a cut of your global earnings. If you were hoping that border-hopping money was somehow invisible to your local tax authority, I really hate to be the bearer of bad news.
But hey, don't panic. In this explainer, we've got a clear agenda to figure this out. We are going to cover 1. Defining foreign freelance income, 2. Busted common tax myths, 3. The double taxation dilemma, 4. Your 6-step compliance guide, and finally 5. Legal deductions and credits. This is going to keep you out of trouble and, most importantly, show you how to legally maximize the money you get to keep.
All right, let's kick things off with Section 1, Defining Foreign Freelance Income and what actually counts.
So what exactly counts as foreign income? Basically, it's any payment you receive from a client, platform, or business located outside your home country. Picture this, you're a graphic designer in Mumbai working for a client in New York, or a writer in Manila invoicing a company in London. That is foreign income. And the kicker? That remains completely true even if you literally never leave your living room, and even if you get paid through an international gateway like PayPal, Wise, or Payoneer. Your tax authority just views all of that as part of your global earnings. Moving right along to Section 2, Busted, Common Tax Myths. We need to separate fact from fiction here.
Because let me tell you, there is a ton of terrible advice floating around the internet about cross-border earnings. Let's start with a huge misconception. The idea that just parking your funds in an overseas digital wallet or a foreign bank account magically shields it. Nope. The reality is that tax liability is usually triggered the exact moment that income is earned, not when you finally decide to transfer it to your domestic bank account. Leaving your cash sitting in PayPal does absolutely nothing to wipe out your legal tax obligation.
Okay, here's another really dangerous one. The myth that small international payments just fly under the radar. Look, global transparency agreements are incredibly advanced today. There's this thing called the Common Reporting Standard, or CRS, which is basically an automated data sharing framework used by over 100 countries. Throw in the United States aggressively enforcing FATCA, and your home country's tax department almost certainly has perfect visibility into your offshore accounts already.
And finally, please don't assume your freelance platform is doing the heavy lifting for you. Unless you are dealing with very specific local regulations, platforms like Upwork, Fiverr, or Toptal rarely withhold income tax on your behalf. You are entirely on the hook for tracking and paying what you owe, not the platform.
Which brings us to Section 3, the double taxation dilemma, getting taxed twice and how to stop it.
See, following the rules blindly introduces a brand new, terrifying threat, getting taxed by your client's country and your home country on the exact same invoice. The root of this whole dilemma is just how governments tax people. Most countries use a residence-based system, meaning they claim rights to your worldwide income simply because you live there for more than half the year, usually 182 days. Then you have countries like the US using a citizenship-based system, taxing you based on your passport no matter where you live. Territorial systems, which only tax local income, are actually extremely rare. So with these overlapping rules, two different countries can very easily claim the right to tax your same dollar. But fortunately, we have double taxation avoidance agreements, or DTAAs. These are basically your ultimate magic weapon. They're bilateral treaties designed to keep cross-border trade flowing and act as a tax shield. So, as an example, if an Indian freelancer gets taxed at the source by a US client, a DTA lets them claim credit for that deduction back home in India, preventing them from paying twice. The catch, though? You have to actively claim these benefits. The tax authorities are definitely not going to do it for you automatically.
All right, now that we understand the baseline threats, let's jump right into Section 4, your 6-step compliance guide. This is the practical blueprint to staying legal.
Consider this 6-step blueprint your absolute survival guide. Step 1. Definitively figure out your residency status. Where do you actually spend the majority of your year? Step 2. Keep meticulous records of every invoice and any withheld taxes. Step 3. Locate the DTAA between your country and your client's country. Step 4.
Convert your foreign income to your local currency accurately using consistent exchange rates. Step 5. Properly report it alongside your domestic earnings. And Step 6. Actually pay what's owed or claim your treaty relief.
Listen, if you skip these steps, the consequences can be brutal. Because of those automated data sharing systems we talked about earlier, governments will flag you. We are talking crushing monetary fines based on unpaid tax percentages, accumulating interest charges from the due date, and, in severe cases, completely frozen financial accounts or even legal prosecution for tax evasion. It is literally just not worth the risk to ignore this.
Okay, now for the fun part. Section 5, Legal Deductions and Credits. This is how we go about maximizing what you actually keep.
Because yes, we've established you have to pay, but you can aggressively lower your taxable liability by deducting legitimate business expenses. We're talking about the internet bill you use to communicate with overseas clients, your creative software subscriptions, home office expenses, laptops, and cameras, even the platform fees Upwork charges you, or the currency conversion charges from your bank. By systematically tracking this stuff, you legally shrink your taxable foreign income and keep way more of your hard-earned cash.
Now, when it comes to keeping that money, you really need to understand how your specific DTAA relief works, because there's a massive difference between a credit and an exemption. A foreign tax credit means you subtract the tax you already paid abroad from what you owe at home, basically offsetting the cost. But a tax exemption, that means the specific foreign income is entirely excluded from your home country's taxation altogether. Which one applies to you depends entirely on the specific treaty your country has signed.
Oh, and a super quick note on indirect taxes like GST or VAT, those local consumption or sales taxes you see everywhere. Generally, if you're providing services to a foreign client, it's considered an exported service and is often zero-rated or totally exempt from GST and VAT. But you might still be legally required to register for it if your total global income hits a certain domestic threshold. Just make sure you are receiving your payments through proper, traceable foreign banking channels so you can actually prove it's an export.
So, let's bring this all together. Managing your foreign income tax really is the foundation of a sustainable global career. Set up your systems, understand your residency, and keep what's rightfully yours. But for all the digital nomads out there constantly border hopping to avoid these rules, I want to leave you with one final, kind of terrifying question. By ignoring your residency status and constantly moving around, are you setting yourself up to be claimed by no country or penalized by all of them? Thanks for joining me on this explainer, and I'll catch you on the next one.